Welcome to Talk Takers, your deep dive into earnings call intelligence. Today we are focusing on BellRing Brands, that sticker BRBR, and their fiscal Q4 and full year 2025 results.
Yeah, this call was something else. It happened pre-market on November 18th, and it really sent the market into, a bit of a panic at first before a really wild recovery.
It was pure investor whiplash, and that's the central tension we're going to unpack today.
Exactly. I mean, on one hand, you have this incredible top-line performance. BellRing is a leader in a booming category, ready-to-drink protein shakes. But that great sales number was just completely overshadowed.
Overshadowed by a huge margin compression. And, this is the big one, a major recalibration of their future growth targets.
A necessary haircut, you could say.
Right. So how does a company with a hit product, growing sales by over 16%, suddenly miss on earnings and slash its guidance? That's our mission today, to figure out what happened on that income statement and why management decided to hit the reset button.
Okay, so let's start with the good news, because there was some. The demand. Q4 net sales hit $648.2 million.
And that was a beat, right?
A serious beat, up 16.6% year over year, and about 2 to 3% above what the consensus was expecting. The tailwinds here are, they're just undeniable.
And we should pause on those tailwinds because they are structural. We're talking about the general shift to health and wellness, sure, but there's a more acute factor here, the rise of GLP-1 drugs.
Exactly right. For patients using medications like Ozempic or Wegovy, physicians are strongly recommending high-protein diets to preserve muscle mass, and that makes convenient options like BellRing's Premier Protein shakes a direct beneficiary.
So the category demand is absolutely there.
It's robust. The product is flying off the shelves, but here's the pivot. The profitability it absolutely melted.
Okay, so let's get into the numbers. Non-GAAP adjusted diluted EPS was basically flat year over year at 51 cents.
And that missed the Zacks consensus of 54 cents by over 5%. That miss was the first big signal that the cost of selling the shakes was rising, and rising dramatically.
Dramatically is an understatement. If you look at the adjusted gross margin, it took a 620 basis point nosedive.
620. It collapsed to 29.7%. I mean, think about that. That's a serious haircut on your core profitability, and it tells you the company is getting squeezed from multiple directions at once.
So what drove that compression? It wasn't just one thing, was it?
No, it was a triple threat. First, you had mid-single-digit input cost inflation, with whey protein being the main problem.
Okay, inflation. What's number two?
Heavier promotional intensity. They're the leader, but new competition is forcing them to run deeper discounts, especially in that critical club channel, just to hold on to their volume leadership.
And the third piece was, I think, non-recurring.
Right. Costs tied to a packaging redesign. It's necessary, but it hits the margin in the short term. So, the volume story is pristine. Premier Protein is still number one. But the cost of defending that spot has just skyrocketed.
Which means the final profitability number, adjusted EBITDA, landed at what, about 117 million?
117.4 million, yeah. But the margin compressed to 18.1%, down from 21% last year. And that Q4 margin performance really set the stage for the big strategic reset.
Okay, so let's move to that strategic reset and the FY26 guidance. This is where the market's attention really zeroed in.
It is. But before looking forward, management did take a moment to highlight that FY25 was, actually a strong year overall. Net sales hit $2.32 billion, up 16%, and they generated really robust operating cash flow.
$260 million in cash flow.
Exactly. And that cash flow is crucial. BellRing isn't just a growth story, it's a cash machine. And they proved it by deploying $473 million to repurchase about 7% of their outstanding shares.
Let me push back on that for a second. A 7% buyback. When your forward growth visibility suddenly gets weaker, couldn't that look like management is just running out of better ideas for their cash?
That's a fair question. I mean, management would argue they're just returning excess capital from a mature cash-generative business. But you're right, the proof of that maturity came right after.
The long-term growth algorithm update.
That was it. They formally cut their annual revenue growth target from that low double digits number.
The hypergrowth rate.
Right. That's gone. Now it's a much more realistic scaled 7 to 9%.
So that's the official pivot from disruptor to, let's say, a scaled compounder. And they kept the EBITDA margin target at 18 to 20%.
Right. Basically saying we'll be disciplined on profit, but the pace is slowing down for good.
Okay, so if the algorithm cut was phase one of the fear, the actual FY26 outlook was phase two.
Absolutely. Management guided FY26 net sales to a range that implies only 4 to 8% growth. So that's already below the midpoint of their new algorithm. And the EBITDA margin was guided to the bottom of the range at 18%.
But the immediate pain point, the thing that really shocked people, was Q1.
Oh, yeah. Management explicitly warned that Q1 FY26 net sales are expected to decline approximately 5% year over year.
A decline, with an EBITDA margin of only, what, 16%?
Around 16%, yeah. That is the number that terrified the market at the open. A 5% decline forecast right after you've been talking up these strong GLP-1 tailwinds. It just looks like a massive execution failure on the surface.
So how did they justify that? If the category is booming, how do you forecast a sales decline?
They explained it as temporary timing issues. First, really difficult comps in the club channel from last year. And second, and this is crucial, they pointed to an $8 million Dymatize sales pull forward.
So they sold product in Q4 that was meant for Q1.
Exactly. It creates an artificial hole in the upcoming quarter. So the whole thesis now rests on this pivot that growth will reaccelerate strongly from Q2 onward as their new investments kick in.
Which brings us to where they're putting their money, that margin compression. It's not all bad news, right? Some of it is strategic.
It is. They're cranking up advertising spend to 4 to 5% of net sales, up from about 3%. They're deliberately trading near-term margin for, household penetration and a deeper brand connection.
They're paying to lock down the consumer. And innovation is the other key piece.
For sure. They're looking beyond that core gym goer. They highlighted their non-dairy almond-based shakes, which are already the number 2 item in that segment. But the really exciting launch is the new coffee house line.
Tell us about that.
It's just smart targeting. It combines 30 grams of protein with the caffeine of 1 cup of coffee. It's for the consumer looking for protein and energy in the morning. That launches mid-December, right in time for their Q2 acceleration story.
That sounds promising, but it doesn't solve the bigger headwinds, the things outside of their control. Let's talk risks.
Okay, first big one is tariffs. Management anticipates new U.S. dairy protein tariffs, which they expect will hit gross margins by about 120 basis points. That's a structural cost increase.
And what about the competition we mentioned?
Yeah, it's a real fight. We're seeing brands that used to just be in protein powder crossing over into ready to drink. They're attacking the club and mass channels, forcing BellRing to spend more just to defend their shelf space.
And we have to mention the legal overhang, the investigation by Blakemore, Fonte, and Old LLP.
We do. You can't ignore it. It alleges misrepresentation of demand or inventory loading in the past. Now, if any of that were to prove true, it would seriously damage the company's credibility and the entire valuation thesis. It's a risk that requires close monitoring.
So you take all of that, great sales, terrible margins, lowered guidance, a scary Q1 warning, and the stock plunges 15% at the open. A classic knee-jerk reaction.
But here's the signal. The shares rebounded and actually closed up 2.5% on the day, on double the average volume. That huge swing tells you that by the end of the day, investors had accepted the reset.
They decided Q1 was a temporary, de-risked speed bump. The conversation shifted from how fast can they grow to can they compound at 7 to 9% and return cash.
And now the entire story for the next 6 months hinges on Q1. Management has set an extremely low bar. Any deviation will immediately reset the stock's trajectory.
Agreed. And speaking of that low bar, let's move to our final segment.
This is not financial advice.
The setup here is pretty unique. Management has, as you said, aggressively de-risked FY26. They've baked in tariffs, competition, and an extremely weak Q1 forecast. A 5% sales decline, a 16% margin. They're betting big on a powerful acceleration from Q2 onward.
And that disparity between the awful Q1 guide and the new, stable, long-term algorithm creates a really interesting trading scenario. We know the stock's implied volatility is already sky high in the mid-80s.
So you see a high-risk, high-reward chance to play against that conservatism.
Right. If Q1 is even slightly less bad than guided, or if management comes out and strongly reaffirms that Q2 acceleration, the market could reprice the stock very, very quickly.
So what's the pitch?
The pitch is a directional options trade. We'd suggest buying out-of-the-money call options that expire just after the Q1 FY26 earnings release. It's a way to hedge against all the negative sentiment that's already priced in. You're positioning to capitalize on a short squeeze if management beats their own self-imposed low bar.
A high-leverage bet on under-promise and over-deliver.
Exactly that.
So, zooming out on the whole thing, BellRing is cementing its dominance, but they're paying for it with compressed margins and a slower, though still healthy, growth trajectory.
And that leads to the final provocative thought for you. Management is really focused on expanding beyond the club channel. They're partnering with food, drug, and mass retailers to test moving their products into higher traffic aisles.
So getting Premier Protein out of the legacy protein section and maybe into, like, the beverage aisle or near the checkout.
Precisely. But that is expensive and it is difficult. It means new contracts, higher fees, different logistics. The big question for investors is whether this aggressive out-of-aisle strategy can actually drive enough new volume growth to offset all the other pressures we've talked about: inflation, tariffs, and competition.
It's a costly transition, and execution is everything. The market will not tolerate a slip-up in Q2 if Q1 is as weak as they've guided.
That's the bottom line.
Stay well informed, and we'll catch you on the next Deep Dive.